Hi, welcome once again to the reading 45 of CFL Level 1 Fixed Income for 2021-2022. In this chapter, we are going to talk about the asset backed securities. Basically, it is going to be an introductory chapter in your Level 1, and that would definitely build the foundation for your Level 2 and Level 3, where the structured finance will be discussed at depth. Some of the defined learning outcome statements of this reading are we're going to talk about the securitization, the very need for it. Then we're going to talk about different structures of securitization, what is meant by the agency and non-agency backed securities. How do we go about creating a subordinated structure, and what are the tools of credit enhancement, then different sorts of mortgage-backed securities called as RMBS, residential mortgage-backed securities, and the commercial mortgage-backed securities, their overviews and key differences. We're going to also talk about how the cash flows are distributed across various risk tranches and credit tranches, and what are the risks associated with the total structure of subordination itself. We will also talk about the mechanism through which the different interests of different risk appetite uh, holders of investors, potential investors are captured. And as a parting note, we're going to talk about something called as a collateralized debt obligation, or the CDO. Okay, so to begin with, the first thing that we need to understand is that what is the need for securitization. So suppose we are talking about a bank. Let's first talk about the bank, which has been shown here. Now, the bank is operating, let's assume, in a defined geography with a defined demography as well. So the bank is doing a good business out there. It almost enjoy the status of a monopoly organization in that particular geography, in a particular community. Okay, so this would mean that each and every community member, or the ones in the neighborhood, will be either be a depositor to the bank, wherein they will be parting their deposit, or they will be a borrower to their bank. Am I right? So typically, as some of you will be doing that, the bank's main purpose is to act as a conduit between these two entities, and that is how banks operate, the commercial banks operate. Now, as far as the borrowers are concerned, the bank made something as simple as something called as loans or advances, and these are the main sources of revenue. Of course, these are the assets on the bank's balance sheet, and the interest income, or the interest income, are the main avenue through which the bank actually generates its income, profit and statement, and etc. Okay. Now, what are the risks? Now, with every passing or every incremental loan, the bank also buys in something called as the default risk. Now, that is the risk basically that the borrower may not actually be able to pay the bank its requisite due, either on time or actually altogether defaulting on it. Or the borrower may delay the required cash flow payment in the form of interest, as well as either a part principal or whole of it on time. So that means that essentially a bank actually buys in risk with every incremental business, right? Now, at the same time, the bank's one of the primary objectives of the bank also, if it has to operate as a commercial bank, is to meet its regulatory target. And as part of the regulatory target, as laid down by that sovereign central bank, there could be a minimum cash reserve ratio, there could be certain liquidity ratio, then there could be certain stipulation as known as the priority sector, how much to lend, how much to advance in a particular sector. There might be a capping to it. And basically, to talk about the bank, if it has to operate commercially, then there are a series of regulations that the bank has to follow. In US, the central bank would be that of the Fed. In India, the central bank is that of the RBI. So any bank desirous of working as a commercial bank will have to comply with all the regulation. But obvious that risk management is also one of them, which means that the bank, as part of its loan advances, will also have to see that what are the probabilities that an incremental business that it has procured may go bust. The borrower may intentionally or otherwise may not be able to make the payment on time or altogether default, right? So that means that the bank has to look forward to some ways of mitigating the risk. Mind you, here I'm not talking about completely eliminating the risk, because the risk is concentrated at the source itself. No amount of banks working can actually mitigate the risk which is originating from the source. No, that's not what it is talking about. So by risk management, it is not talking about the elimination of risk. By risk management, we are talking about finding ways to negate that risk. And this is exactly where the concept of securitization comes into picture. So the concept of securitization essentially talks about transferring the risk ownership of the bank, right? That's number one. Number two, to diversify the bank's portfolio. And by means of diversifying the bank's portfolio, it also diversifies the risk element of its loan portfolio. And at the same time, the bank also ensures or has to ensure that there is sufficient liquidity at any given point in time on its balance sheet in order to meet any contingent demand or to satisfy the depositor's interest, right? So if we sum it up, we may understand that with every incremental loan advance that the bank makes, the bank indirectly also buys in an equivalent amount of risk, however minuscule. The second thing is the bank will also have to comply with the central bank's regulation and other stipulation. And the third thing is that the bank at any given point in time will also have to retain the liquidity in its balance sheet. So given all that, securitization could be an answer to that. On the other hand, securitization also lets certain class of investors to participate in the country, or at least the geography that I was mentioning, in the economic activity of it. So from the investor's perspective as well, depending upon the risk appetite, certain risky assets could be transferred from the bank's balance sheet to the risk investors. But obvious that against that risk that the investor assumes, the investor expects certain high yield. Securitization could be an answer to that. So in a nutshell, a securitization is a securitized asset, or the process of securitization basically brings in together the risk transferee and the risk transferor to a common ground, binding through a common interest. It also helps in mitigating the risk in order that it is being diversified instead of it being concentrated in one particular bank's balance sheet. So this is the very basis on which the securitization problem, on the structure of securitization is constructed. Okay, so let's take a look at how exactly the thing happens. So let's suppose that the bank that we were talking about, so this is the particular bank. This is your neighborhood bank. It's a good bank. And the bank has a different loan portfolios in the form of housing loan, which is also known as the mortgage, auto loan, basically the car loan, etc., etc. There could be student loans, there could be credit card receivables, and then there could be personal loan as well. So there could be commercial loan as well. Now, these loans, the structure of securitization necessitates that these loans be put together in a pool of borrowers who would be actually be borrowing from the bank from different accounts, from different products. As mentioned before, it could be a home loan, it could be a commercial loan, it could be a student loan, credit card, personal loan, etc. Now, these loans on bank's balance sheet are called the collateral from the securitization point of view. Now, through the help of an underwriter, these loans are pulled in together, and then through a process called clean break is being sold to an intermediary called the SPV, or the special purpose vehicle. The special purpose vehicle is basically almost a subsidiary of the bank. However, legally it is separate from the bank in the sense that it is bankruptcy remote. Now, how is it bankruptcy remote? We will discuss about it in the subsequent slides. Suffice to say, as far as this slide is concerned, that the underwriter engineers this whole process. More often than not, this underwriter is basically an investment bank that helps engineer this pool of borrowers' loan portfolio into tradable assets. The bank, in turn, makes a clean break in the form of selling of this loan portfolio. The selling of this portfolio de-risks the bank's balance sheet, as has been mentioned before, and also enhances the liquidity position of the bank, thus enabling the bank in making further loan advances to a marginal client. The underwriter, of course, through a process of engineered notes, repackages this loan portfolio altogether into a note, a security which can be traded in the market. And depending on depending upon the risk appetite, there is a pool of investors. The pool of investors would buy these securities as has been packaged by the underwriter, and then the cash flow will happen in such a manner that they would in turn will be helping the trust making the cash flows to the bank. So the bank, from the loan pool of borrowers, sells this loan portfolio to the intermediary called as the special purpose vehicle through a process called as clean break. The underwriter facilitates that operation, and that is being funded by the pool of investors having diverse risk appetite. The underwriter facilitates that as well, and this loan portfolio are repackaged as notes. So essentially what happens now, that the bank is off the hook as far as this whole structure is concerned once this clean break or true sale has taken place. The borrowers, on the other hand, they will be paying their principal as well in an amortized manner or in a balloon manner, as well as the periodic interests. They would definitely be paying it to the bank, but the bank would no longer will have any legal sanctity to this cash flow. So this pool of borrowers, when they make their interest payment, this interest payment ultimately, because of this structure, flows through this SPV and ultimately is being paid to this investor in the form of coupon. As well as whenever these borrowers make their principal payment, either in the form of amortized principal or balloon pay, that principal also flows through this structure, this SPV structure, and is passed on to the pool of investors. So the pool of investors essentially act as a bond holder to these risky assets. Now, to facilitate all of this, of course, there is a trust that oversees the day-to-day operation, and also the trust acts in the best interest of the investor, though it is appointed by the bank. There are other entities associated with this structure in the form of law firms, which drafts the legality of the notes, delineating the rights and privileges of the investors and the covenants of the trust, the SPV, and different functions that are to be discharged by different parties associated with this whole structure. In order to entice the investor. The rating agencies are also roped in. The rating agency, through their process of stipulation and placing certain covenants, necessitates certain action in order to secure high rating. High rating would mean that more and more investor participation can be guaranteed, and at the same time, the higher interest rates also becomes a big enticement for the borrowers, for the investors. So this is how the whole structure works. The securitization essentially delineates the original borrower who were tied with the bank is now spread through the entire economy as this pool of investors fund this loan portfolio. Through this process, the bank has essentially also transferred the ownership of the assets as well as the risk. Now, in absence of securitization, what would have happened? In absence of securitization, even if there were the investors, there were a couple of risks which would have ensued, and the investors would have to bear those risks. The first of that kind is typically run on the bank. Now, if there is a run on the bank or any financial institution, see, before I actually dwell into the depth of it, from the bondholder's perspective, there are two distinct sources of risk in absence of securitization. If this structure that I just mentioned here, if the structure was not there, then the kind of risk that the investors would face would have originated from two sources. One is from the bank itself, and second is from the pool of borrowers. How is it so? Now imagine if there is a run on the bank. The run on the bank essentially would mean that the bank has actually run out of cash in order to meet the short-term interest liabilities. If such a thing happens, then the depositor to the bank will have the first claim on the bank's assets. And the bank's assets are basically these loans and advances that the banks would have met. In such a situation, if there is no process of securitization, in absence of securitization, the bondholder would have been left in lurch because they would be subordinate, their interest would be subordinated to that of the depositors of the bank. Secondly, even if there is not run on the bank, the bank's activities or the financial health could render into it experiencing a rating downgrade. And the rating downgrade, as I have mentioned before, if it is persistent, would eventually lead it to default, which brings us to the first problem itself, that in case of default, the bank would experience a run on the bank, which would mean that the depositors would have their first claim on the bank, thereby depriving the bondholders. And the second source of risk could be that the bank itself would have been doing good, but certain section of the loan portfolio would have turned bad. That means there would be some portion of the non-performing assets which are tied with the bondholders. So the securitization food chain that was otherwise creating that steady cash flow would be challenged if the collaterals, they start turning bad. And as has been mentioned before, that entire securitization structure, these loan assets are collectively called the collateral. The process of creating an SPV and from where the structured notes originate are called the asset securitization process. And the notes itself that emanate from these structure is called the Asset Backed Securities, or in short, ABS. Now these terms are very, very important, and I want all of you to rerun this portion of the video in order to glean through the concept. So as I explained, that there are a couple of sources of risk as far as the bondholders are concerned. So first risk is the bank itself. And the second is the point of origination from the non-performing asset. Now, the non-performing asset could present risk again in two fashions. One is the direct default, wherein the borrower fails to make its contingent payment, makes its scheduled payment on time, or it persistently delays those payments. So, which would mean that the borrower is not exactly in default, but there is a foregone interest because the interest and because the scheduled interest and the principal payment are not paid on time. Well, that leads to a problem of prepayment, which is famously in the context of structured securities called the extension risk. We're going to study about it in detail in the subsequent slides. So, the risk ultimately that manifests at the bondholder's end do originate from two sources. One is that of the bank, and second is from the loan portfolio or the borrower itself. Now, there are a couple of more risks that the bondholders are exposed to as far as these structured notes or these asset-backed securities are concerned. The first is both of them put together are called the prepayment risk. The prepayment risk are again subdivided into two main forms. One is called the extension risk, and other is called the contraction risk. When the market interest rates plummets, anecdotally, it has been observed that the borrower tends to make their part payment when the market interest rate plummets. In such a situation, or borrower refinance when the market interest rate plummets. In such a situation, the bondholder runs the risk that their principal that they have invested in the securitized structure might be retired early. In case it's retired early, the bondholders risks the continued coupon payment which they were enjoying for the elongated period. So originally, if the structured notes were so devised as to have a tenor of 10 years, because of this early part payment, it could so happen that the average life may come down from 10 years to 7 years, which effectively reduces the bondholders' cash flow for the additional 3 years they otherwise would have enjoyed. So there is an opportunity loss because of this. Add to this that when the cash flow is retired back, the bondholder or the investors to this structured notes face an additional risk of reinvestment as well. Exactly opposite of this risk of contraction, there is something called as the extension risk, which we have just discussed, which originates because of the persistent delay in making the payment on time. So, which is also known as the delinquency. The extension risk would mean that the borrower, the average life of the structured notes, which otherwise would have been 10 years, in this case, the bondholder runs the risk that it might get extended to 12 years. So what is the risk out here? The risk is that the continued delay has also an element of a default embedded in it. So this is exactly opposite, diametrically opposite to what we have just discussed in case of the contraction risk. And at the same time, the bondholder may again forego a typical reinvestment risk, again buying a typical reinvestment risk because of the delayed principal retirement. They might be foregoing a better investment opportunity because of the additional couple of years that they bought in because of this delinquency. So these are a couple of risks which are important, and we must understand that. Now, coming back to the risk associated with run on the bank, there are 4 things that ought to be understood. We are going to obviously discuss them at length in our subsequent chapters, but I just want to touch base upon it. Absolute priority rule dictates that should there be a run on the bank, then according to the seniority of the creditors, the bank's assets must be disposed of and their liabilities must be discharged accordingly. The other problem is that making a pivotal choice between that of liquidation and reorganization. Needless mentioning that both of them present substantial risk ultimately to the bondholders. The third thing is that whenever there is an aggrieved party or the one who have been impaired, whose interests have not been served, typically the subordinated creditor in the bank's balance sheet, they might drag the matter down to court, and the judge might take a contrary view to the absolute priority rule or any other stipulation that has been mentioned while the bank was formed. And that may actually indirectly hurt the interest of bondholders. Now, this is an additional thing that I wanted to depict, but nonetheless is an important. Okay, so we now try and define the various kinds of issuers that are various kinds of structured notes of the classification, starting with the structure itself. So there's something called as the pass-through securities, subordinated structure, sequential pay, and the packed tranches. So we're going to touch base all of them. What is meant by pass-through securities? So just imagine I am obviously not drawing the whole diagram as has been depicted in the earlier slide, but let's just take a point reference that here is a bank, and then here is the trust or the SPV, and then here is the bondholders or the investors, and there is a pool of borrowers. Now, the borrowers, as has been depicted before, that the borrowers typically to a mortgage-backed security would be making two sorts of payments. One is through an equated monthly installment that comprises of the interest portion as well as the scheduled principal, and another is called as a part payment or the prepayment. Now these are the cash inflows. These are the cash inflows to the bondholder, whereas the cash outflow is the initial funding of this securitization, which ultimately helps the bank fund the borrowers. Now, once this securitization chain has been formed, the cash flow from the borrower's pool will ultimately fall into the investor's back bucket as it is, minus the servicing fees that are charged to the bank and the SPV. That kind of securities are called the pass-through securities. Now, to illustrate the matter further, let's assume that the loan interest rate is something close to 10%. Since the borrowers do not have a direct access to the bondholders or the investors, the bank and the SPV will still act as a conduit between these two entities. However, as has been said before, that this SPV is legally separate should there be a claim on the bank. Now, coming back to this cash inflow, the borrowers, let's say they're making a monthly interest payment. They're making their payment, the scheduled payment, which carries an interest rate of 10% per annum. Now, this SPV and the bank put together, because of the servicing fees that would include the cost of servicing the loan, the administrative jobs, And if that's charged to the extent of, let's say, 1%, so the balance 9% is being passed on to each of these bondholder in an equitable proportion tied up to the investment, to their respective bondholders' investment. Such a kind of arrangement is called a pass-through security. Through the pass-through, of course, this is just one of the various ways by means of which the securitization process is being structured. The second in line is something called as the subordinated structure. Now, this subordinated structure basically gleans out different risk different types of investors classified according to their risk appetite. And the subordinated structure, the notes pertaining to the subordinated structure are formed through this pass-through securities. That is to say that the pass-through securities acts as the base or the collateral to the subordinated structured notes. In the same fashion, there is something called a sequential pay, and then there's something called as the PAC tranches, or the planned amortization tranches. We're going to discuss all of them, all three of them, subsequently as we move along the slide. But just remember that whether it's a subordinated structure or a sequential pay or a PRAC tranche, all of them are ultimately devised, all of them are ultimately engineered, repackaged through this pass-through securities, which form the basic collateral. Now, in the US, the structured notes are typically originated from a couple of parties. One is the agency-backed party, and another is the non-agency. So what do we mean by that? The agency-backed securities are the ones that are actually issued by the government itself. The Ginnie Mae is the whole and sole, as of now, the whole and sole entity in the US that issues agency-backed securities. Now, this is completely guaranteed by the Fed itself for 100 cents to a dollar. Hence, the agency-backed securities do not need something called as credit enhancement. Their bonds, as the bonds originating from the agency-backed securities, are as good as default-free. As an extension to these agency-backed securities, there are quasi-government or almost semi-government entities like the Fannie Mae, Freddie Mac. They are almost as good as the agency-backed securities themselves, but they're not backed by the full faith of the Fed. And hence, they would require this credit enhancement, either in the form of the insurance or some sort of other external intervention. Now, we must understand that there is certain underwriting standards. So the ones that meet the underwriting standards requiring the full faith of the government or minimal credit enhancements are almost guaranteed to not default. Of course, in the subprime crisis of 2007-2008, we did see the falling of Freddie Mac, falling of Fannie Mae. Those securities were also rated AAA, AA, which were very keen, very similar to a default for a security. On the other hand, these high-class securities are also called the prime securities because they meet the highest underwriting standard. On the other hand, there could be securities that are issued by the private players which are not backed by the Fed and do carry an extensive credit enhancement tools. They are called the non-conforming securities. So we need to understand that whenever the underwriting standards are of the highest orders, they are called the confirming securities, and all confirming securities are agency backed, whereas all non-confirming securities are non-agency backed. The non-agencies at times can also have in their portfolio some confirming securities. Now, what we mean by the issuer here? By issuer, we are essentially talking about the underwriter, that investment banker that actually structured the notes after purchasing the loans from the bank. As far as the cash flow distribution is concerned, the structured notes could either be interest only, principal only, fixed rate, variable rate, or a combination of fixed and variable rate, non-amortizing or amortizing or bullet pay. So typically it could so happen that as we move along, we will understand that when we are talking about the pool of investors, so the pool of investors are obviously not homogeneous in nature. So there are various sorts of investor, ranging from the one who are almost 100% risk averse to ones who are considerably risk seeking. Needless mentioning that ones who are risk averse would like to have the securities in their portfolio that are almost default free. On the other hand, the risk seekers wouldn't mind to own a few risky securities in their portfolio in bargain of higher yield. A securitization process do facilitate by breaking down those structured notes and creating some trance securities in such a fashion that the overall riskiness of the pool is redistributed between different sets of investors fulfilling their own risk appetite. So, as part of this cash flow distribution, the lower ranked tranched or the lower ranked securities, which are known as the risky securities, could only be concerned or only be invested, remain invested in this whole structure as an interest only bearer. On the other hand, there are investors who are only interested in having a lump sum bullet pay to their portfolio from the structured note, or an amortized principal to their portfolio. So those are the principal only investors. To elucidate matter further, let's assume there is an investor A who is a risk averse investor, and another is investor B who is a risk seeking investor. Investor A invests, let's say, $100, with the understanding that over the next 10 years he will be paid in the form of $12 each year. So at the end of 10 years, against the $100, he would have been totally paid $120. So this is a principal only sort of cash flow. On the other hand, the interest only would have invested, let's say, 100, and would be receiving as part of his cash flow, let's say $14. But this $14 carries considerable risk, which may necessitate that at the end of the tenure, the investor B may or may not receive back the principal, unlike investor A. So there are different kinds of investors, and different kinds of investors have different kinds of risk appetites. The varying risk appetites, their interests are being met through this structure. There could be a combination of both fixed and adjustable rate mortgages as well. The amortizing versus the non-amortizing notes, we have already discussed in our preceding chapters about amortization. So amortization is either planned or partial. So planned amortization would mean that some portion of the principal is being retired with every payment from the borrower's end. Hence, accordingly, the same cash flow is received at the investor's end. If that is the case, now let's take an example back of investor A. So if it is an amortized security, so he might be receiving, let's say, 14, which would include 12 of his principal and 2 of his interest. Okay. On the other hand, in an amortized security, investor B would be receiving, let's say, 16, of which, again, 10 would be 12, 14 would be interest, and 2 would be principal. So these 2 here and this 2 here, they are the amortized principal. As opposed to amortized principal, the other payment methodology is through something called as non-amortized balloon pay or bullet pay. So whatever we did study as part of our retiring of bonds in the preceding chapters, the same concepts apply to the structured securities as well. The only thing is we are discussing from the point of view of the ultimate bondholder or the investors. By asset type, there are a couple of things that we need to understand. The mortgage-backed securities mean the collateral to this are basically the home loans or the commercial mortgages. So they are subdivided into 2 parts. One is called the residential mortgage-backed securities, and another is called the commercial mortgage-backed securities. So the residential mortgage-backed securities is basically house, whatever you want to call it, flat, a villa, an apartment, doesn't matter. On the other hand, the commercial mortgage-backed security could be an under construction mall, a shopping mall, a hotel, a resort, an office, or any other commercial complex. Now, the structured notes could be subdivided into how they are actually formed. The assets backing those structured notes, if they originate from the mortgage, they are called the MBS securities. By the way, the MBS securities form the largest share as far as any asset-backed securities are concerned. The other asset-backed securities other than the mortgages are called the auto loans, the credit card receivables, the personal loans, student loans. There's something called as collateralized mortgage obligation. Collateralized mortgage obligation typically is really not an asset in itself, but what it does is that it creates a fundamental difference between how the riskiness, the 2 counteracting risks of structured notes are actually separated, and they actually are negated by 2 separate sets of bondholders. So that is how the CMO differentiates. The other hand, CDO, or the collateralized debt obligation, is basically a leveraged structure wherein the CDO manager has a primary motive of earning an arbitrage spread. So typically, again, these 2 are really not true asset class in the sense that they are re-engineered from a pool of mortgages, unlike the first 2, wherein the real assets act as collateral. The assets in CMO and the CDO have either a previously defined structured note in the form of a pass-through security or any other complex mechanism. Basically, they don't have any hard asset with a direct linkage, but they have loan portfolios. And from those loan portfolios, the structured notes that are created, those structured notes, those pass-through notes may act as collateral. So these are advanced notes that are being created in the market. Okay. So as we were discussing out here, let's get back to the mathematics. And I'm sure that after the discussion that we have had about the pass-through securities, this slide should be relatively easy. So as we were mentioning that there is a pool of borrowers, there's the pass-through pool, and there's the pass-through investors, and then there is the loan originator. Now, as we mentioned that everybody is exposed only to the extent of their investment, the cash flows pass on from the original borrower to the loan originator, which is basically a warehouse lender or a bank, through SPV, and ultimately the cash flows reach to the investors in the form of coupons and sometimes as the amortized principal. Now, of course, that is a net of any services fees. As opposed to that, the structured note have different risk mechanisms, different risk to reward manifestation. So let's just get into it. So let's talk about 150 million straight pass-through coupon, 150 million asset-backed securities, the coupon of which is about 9% in a tenor of 11 years. And as opposed to that, from the same structure, we could create this structured security, which is also called as the subordinated structure. And how this subordinated structure works, we're going to get back to it a little bit later. But let's just work out a few details out here. So let's imagine that from the same structure, we create another one wherein we designate somebody as the senior notes holder, the face value of which is 100 million, having a coupon of 8 years, and the tenor is 10 years. The mezzanine holders are the ones, the face value of which is 40 million, but they enjoy a higher coupon of 10% and a tenor of 12 years. And then there is something called the subordinate holders, the face value of which is only 10 million, but the coupon is much higher than the previous two notes holder along with the tenor. Now let's just, to the extent of the face value, let's just work out certain things. So let's say if through this structure, if we have to find out that did we create something out of thin air, we actually did not. Through a process of something called as a weighted average coupon, let's see what is the weighted average coupon of this whole structure. So the weight of the senior notes holder is going to be 100, because if you add all of this becomes 150. So the weight of senior note holder is close to 100 divided by 150 multiplied by 8% plus the weight out here is 40 divided by 150 multiplied by 10% plus 10 divided by 150 multiplied by 15%. So if we do this math, then this math comes out to be 5.33 plus this becomes 2.66 plus 1, which is roughly equal to 9%. So this is the weighted average coupon. Now let's see what is the weighted average life. We will say the weighted average life of this structure is weighted average maturity. The weights remain the same. The only thing is that we multiply the same weight with a respective tenor. So the weighted average life comes out to be 0.67 into 10 plus 0.08. I'm sorry, this is not 0.08. This becomes, oops, 3.2 plus 1. So this becomes 11. So the weighted average maturity is 11. The weighted average coupon is 9. So this is exactly the same as that of this pass-through structure, wherein it had 9% coupon and then 11 years of life. So we see that by re-engineering and redistributing the cash flows according to different set of investors attributed to their risk appetite, classified according to their risk appetite, we really did not create anything. There was no innovation. There was innovation, but certainly there is no creation. We simply redistributed the risk reward in a re-engineered fashion by re-engineering the whole notes, by tweaking the individual maturity and the individual coupon, as well as the according to the face value of it. So this is how a structured note is created. So this was the pass-through security, and from the same pass-through security, we have now created a tranced structure of senior note holders amounting to having a face value of 100 million, a mezzanine bond holders of 40, and the subordinate holders as 10. Now the question is, what purpose does it serve? So in this fashion, what essentially is happening is this structure is completely subordinated. And as part of subordination, the subordinate holders is assumed to be the riskiest piece of this whole structure. Should there be any risk of default, should there be any risk of delinquency, the subordinate holders would absorb that first piece of loss. Hence, sometimes this is also called as the equity trance. But just also remember that against the risk that the subordinate holders are assuming, they are being suitably compensated with a higher coupon. Next in line are the mezzanine bond holders, which are somewhat less riskier than the subordinate holders, but nonetheless, up to the extent of their face value, they would protect the senior-most claimant or the senior-most note holders in this whole structure by absorbing any default that is beyond the subordinate holders. So to the extent of their face value, they would shield the senior notes holder. The senior note holders, at the cost of a lower coupon or lower yield, enjoy this extra protection being provided by the mezzanine bond holders as well as the subordinated structured notes holders. So in this fashion, since this subordinate note holders' interest of default has been projected, this is called as credit tranching. At the same time, in this whole structure, the notes could be so constructed that the senior note holders will be promised their scheduled cash flow, and there be any risk of delinquency, that delinquency is being absorbed by the subordinated structure. And that is being called as the time tranching. So the time tranching would essentially mean that if there be any delay in payment, that is going to be absorbed by the subordinate note holders, followed by the mezzanine bond holders, so that the senior note holders' interest is protected. So this is the prime difference between a pass-through security and that of a trance security. And also, we must understand that there is the prepayment risks are a couple of prepayment risks manifest this in a couple of ways. One is the extension risk, which we just discussed here, and another is the contraction risk. The contraction risk would mean that there is an extra payment being happening as a form of part payment, and in such a situation, the average tenor, which was first promulgated as 11 years, may not remain so. So, in a tranced manner, even that interest could be protected by letting the subordinate holders absorbing the accelerated payment in the form of part payment or prepayment, thereby going bust or thereby retiring their part of the principal first. So, to the extent of their face value, the subordinate notes holder will protect the interest of the mezzanine bond holders, which in turn will protect the interest of the senior notes holders. So we saw that both in case of credit tranching, the credit interest rates of the senior note holders are placed with the paramount importance and they are being protected. And also, both sorts of prepayment risk, either contraction or extensions, are also being absorbed by the subordinate holders, such that the senior note holders are immune. In contrast to that, a CMO structure would necessitate creation of two contradictory tranches. In this case, essentially, what happens that, let's say there is a senior tranche and then there is a junior tranche, and there is this pool of borrowers. The pool of borrowers do make their routine payment in the form of their interest and principal. Now, within this subordinate structure, which is also called the collateralized mortgage obligation or the CMO structure, there are a couple of CMO structures that are more famous. One is called the sequential pay CMO structure, which is more common. Another is the packed tranche or the planned amortization curve. The packed tranche we will discuss in the subsequent slide when we understand what is meant by packed. Suffice to say that if we start discussing the sequential pay, in the case of sequential pay, which is not a true subordination, two different sorts of interests are being served here. So in a typical structure, the senior notes holders interest is being paid first, and their principals are also being paid first, following which the interest of junior notes holder are being paid. The arrangement is such that so long as the senior notes holder's principal is not paid, the junior notes holder will not receive their principal. So they will be deprived of their principal till such time the senior notes holders are completely retired. So to that extent, the junior notes holder enjoys an elongated period of interests. But the cost of that is, should there be any default, they will be absorbing the default here. And if there be any, and they are also exposed at the same time, they will also be exposed to something called as the delinquency, which means that any delay in payment, they will suffer first, because they're providing some sort of protection to the senior notes holder in the form of absorbing their part of the principal only after the senior's interest and principal both are served. On the other hand, the senior notes holder are susceptible to contraction risk. they're obligated to absorb any part payment that happens, an accelerated part payment that happens, which is other than the scheduled payment of the principal, which means that in a typical sequential pay CMO structure, if the average life in the beginning of the structure itself was conceived as a 10 years, because of this arrangement, it could so happen that the senior tranche may be retired in 8 years itself. Or it could also so happen that the junior tranche may be retired only after 14 years, because two counterproductive risks are at play, and two counterproductive risks are being so distributed that one actually provides indirect immunity to another. The junior tranche provides the immunity of extension risk to the senior tranche, whereas the senior tranche provides the immunity of contraction risk to the junior tranche. Hence, it is not a true subordination, but it actually negates the interest of two different risk appetites in one structure. Now, let's also assume that apart from this, there's something called as the plan amortization curve. Now, what is a plan amortization curve? We will discuss it in a little while, what is meant by a plan amortization class. But suffice to say here that a plan amortization is a flavor of sequential pay CMO structure itself. In a plan amortization curve, as we mentioned that before this, in a sequential pay CMO structure, there is really not a true subordination because two different risk appetites are being negated through their mutual interests. But in case of a structure, if a structure can be so conceived that come what may, to the extent a band of the Trance securities, are protected against both sorts of prepayment risks, which is extension as well as a contraction, then such a structure can be termed as the planned amortization curve. In a planned amortization curve tranche, typically what happens that there is a middle band which is known as the solid band, and this band is immune to both the extension risk as well as the contraction risk, which means that if there be a delay in payment from the borrower's end, that risk is going to be absorbed by the support tranche. And also, if there be an accelerated payment from the borrower's end in the form of part payment of principal of mortgage, then that will also be observed by another support tranche, thereby keeping the middle solid tranche or the band of the whole subordination structure immune to any sort of prepayment risk. Such a class of securities are called the planned amortization curve tranches. And this sort of band is also called the pack collar. As we have discussed before, that the MBS can be subdivided into residential mortgage-backed securities as well as commercial mortgage-backed securities. The residential mortgage-backed securities are the largest asset class as far as the structured notes are concerned. The key difference between these two, that is the mortgage-backed securities and the residential the residential mortgage-backed securities as well as the commercial mortgage-backed securities are basically one is recourse type, another is non-recourse type. Okay. Okay, so what we mean by that? So let's say there is a home loan borrower and he has borrowed, let's say, $1 million. with a tenor of, let's say, 20 years. Now, if he chooses to make part payment, he will not be penalized. In fact, beyond a certain point, he will be encouraged, and it should be seen in good standing as far as his FICO core score is concerned if he makes regular part payment of principal, which is over and above the scheduled payment of the principal. So he will not be penalized because of that. Okay. Second thing is that he can, to the extent of the loan that he has taken, he can insure himself against any sort of default by purchasing an insurance against the home loan. And the third thing is that the cash flows that he has to pay, that consists of interest and scheduled principal. As opposed to that, the commercial mortgage-backed securities, which the base assets of which could be, as I said, a mall or shopping complex, etc. They have, strict, they have strict laws against any part payment. So part payment is not seen as a good thing, and they are penalized. Okay. So we take a small break here, and we will return with parts 2 of the AVS. I hope you enjoyed this session.